So recently I've seen a few rumblings about the state of the Australian property market, so I thought it might be a good time to run through a few articles. I'm currently taking advantage of a 14-day trial offer with Macro Business, and I have to say I think it's quite good if you're looking for information on the twists and turns of the Australian property market. Anyway, I'm not going to be making big calls here. I'm not suggesting the property market is about to implode, but there are signs of slowing in the biggest real estate market of Sydney, less so in Melbourne, but of course it depends where you live. As the old saying goes, all real estate is local. If you live in Perth, prices have been declining for a while now. So let's start with a broad macro view of Australia. A couple of weeks ago, the IMF downgraded the growth outlook for Australia from 3% to 2.2% for 2017, primarily because housing investment and mining exports were affected by bad weather earlier in the year. Now, I take economic forecasts, regardless of who it comes from, with a big grain of salt, and the IMF is no exception. More importantly, though, the IMF came out a few days later warning about Australia's growing debt problem. Household leverage and high house prices in Australia and Canada make these economies more susceptible to risk premium shock. There is particularly strong need for financial sector policy vigilance to guard against further build-up of imbalances. The combined debts of government, business and households in Australia are now 147% larger than GDP, up from 87% 10 years ago. Although Australian government debt has risen from 10% to 44% of GDP, it's still among the smallest in G20 advanced economies. But private sector debt, including households and business, is now among the largest in the G20. And the guys at Macro Business produced this chart showing household debt to GDP in the Anglosphere. As you can see, Australia started at around 45% household debt to GDP 25 years ago and is now close to 120%, far outstripping other Anglosphere countries. And according to Macro Business, Australia has the second highest household debt to GDP ratio on the planet, second only to Switzerland. And here's the most interesting data point from this article. Despite the fall in interest rates, the burden of servicing debts for households and business in Australia is heavier now than it was in 2006, when the Reserve Bank's cash rate was almost 5 percentage points higher. The IMF says this raises the question how they would handle a rise in rates. So just think about that. The RBA cash rate is 1.5% today, and you can get a mortgage at around 3.7%, whereas 10 years ago the RBA cash rate was at 6.5%, and you could get a home loan for around 8%. But today, households are even more stretched than they were 10 years ago. And compared to other Anglosphere countries, we spend significantly more on debt repayments as a percentage of household incomes. And again, we have the third highest debt servicing ratio on the planet, behind the Netherlands and Denmark. And one more chart to make you feel even better. Australia's non-financial sector debt to GDP is pushing 240%. I remember back when it blew through 200%, people thought it was off the charts. Now, I don't think sharp hikes in interest rates here in Australia are imminent given the growth outlook, and the futures market doesn't seem to think so, pricing in just one rate rise by February 2019. Perhaps a bigger risk is employment, brought on by an economic shock to the system. And Robert Gottliebsen is warning of such a danger. Yesterday, Gottliebsen put out a piece claiming that in an off-the-record conversation with one of the most influential property analysts in Sydney, they are forecasting that the building rate of apartments in the city is set to fall by at least 50%, which will have severe economic consequences for Sydney. He says apartments sold as used apartments in the big Sydney apartment estates have already fallen by at least 20%, and reckons banks will be reporting a significant rise in problem loans in 6 to 12 months' time. Now, when property developers are finding it difficult to move stock, they start coming out with deals, and that's exactly what Australia's biggest apartment owner and developer, Harry Triguboff, has done, offering depositors with 15% down 2-year funding at 4% for both completed and off-the-plan apartments. Then today, Gottliebsen followed up with another article warning of monumental job losses, positing that when faced with falling home prices, people revise their discretionary spending, with the obvious knock-on effects, combined with rising energy prices, could lead to job losses. And that, I think, is a bigger risk to the ability of households to service debt. The RBA can cut rates in a crisis, households can cut back on discretionary spending, but if you lose your job, interest rate cuts and dining on 2-minute noodles isn't going to help much. Now, a couple of weeks ago, the Australian Bureau of Statistics released data on construction for the June quarter. Yes, that's how slow our reporting is in this country. So it probably doesn't reflect the most recent decline outlined earlier. But the guys at Macro Business concluded that the construction boom looks cooked. As you can see from this chart of dwelling commencements for houses and apartments combined are down 8% from a year ago. Perth started falling much earlier than most, and it's the same story with completions, down 7.3% from a year ago. The biggest falls occurring in Western Australia. So obviously this data is lagging, but it will be interesting to see if the September quarter data confirms the trend. But you won't know that until the data is released in January. So how about the quality of loans in Australia? Remember the rampant use of liar loans in the US prior to the financial crisis. Basically encouraged by mortgage brokers, people lied in their mortgage applications to get loans. In some cases, there was no documentation at all. In this article, the guys at Macro Business refer to the 2017 UBS Evidence Lab Australian Mortgages Survey, in which they asked participants who'd recently taken out a mortgage the degree of factual accuracy in their applications. As you can see, the number of respondents that were completely factual and accurate fell to 67%, which UBS claims is a statistically significant change from the 2016 vintage. Quote, "We see these results as disturbing and difficult to reject, given approximately 1/3 of participants stated their application was not entirely factual and accurate. Further, it is highly unlikely respondents would have stated that they misrepresented their mortgage application when in fact they were truthful. If anything, we believe it is more likely these figures may understate the level of misrepresentation in mortgage applications, as some respondents may not want to state they were less than completely accurate despite the anonymity of this survey." And not surprisingly, the broker channel has shown the biggest decline in factual accuracy. Oh, what's that? You only earned 60K? Just round up to the nearest 100,000. Congratulations, you now qualify for a loan. And how about those no money down for the first 5 to 10 years interest-only loans? Well, they're heading back towards being 40% of all housing loan approvals. Now, it's been higher than that before, so what's the big deal? Well, strict new lending criteria means many of these loans will fall outside new underwriting standards, resulting in more borrowers being disqualified from rolling over their loans on current terms, rising from 7.5 billion to 21 billion by 2020. So a little more stress there for some households on the way. Now, looking at house prices in the major capital cities for the September quarter, according to Domain.com, nationally prices fell 0.5%, with Sydney driving most of that, falling 1.9%. But as you can see, with the exception of Perth and Darwin, which doesn't matter much given the size of that market, all capital cities showed rises over the past year. Nationally, unit prices were flat, Sydney down slightly, but still up from a year ago. Brisbane has been particularly weak, which is commensurate with stories coming out of that market over the last 6 months, and Perth, which has been weak for some time. Now, a little more real-time data on prices in Sydney from CoreLogic shows price declines in Sydney continued for the 7th straight week, and CoreLogic's leading mortgage index continues to fade through the spring selling season across all states except Tasmania, which obviously doesn't count given the level of inbreeding in that state. Also, the guys at Macro Business highlighted some low auction clearance rates in Sydney that are suggestive of price declines, whilst Melbourne continues to hold up reasonably well. Anyway, that's going to do it. Perhaps some cracks appearing in the Sydney property market. If you live in Brisbane, you may have been aware of slowing signs in the apartment market there for a while now. And if the deterioration continues, I might do more regular updates. Let me know if that's something you'd be interested in seeing more of in the comments below. I'll see you next time.